Overview: the insurance industry safeguards the assets of its policyholders by transferring risk from an individual or business to an insurance company. Insurance companies act as financial intermediaries in that they invest the premium they collect for providing this service. Insurance company size is usually measured by net for providing this service. Insurance company size is usually measured by net premiums written, that is premium revenues less amounts paid for in reinsurance. There are three main insurance sectors: property casualty, life, health, and health insurance. Property casualty consists mainly of auto, home, and commercial insurance. Life health consists mainly of life insurance and annuity products. Health insurance is offered by private health insurance companies and some LH and PC insurance, as well as by government programs such as Medicare. Regulation: all types of insurance are regulated by the state, with each state having its own set of status and rules. State insurance departments oversee insurance solvency, market conduct, and to a greater or lesser degree, review and rule on requests for rate increases for coverage. The National Association of Insurance Commissioners develops model rules and regulations for the industry, many of which must be approved by state legislatures. The McCarran-Ferguson Act, passed by Congress in 1945, referred to continued state regulation of the insurance industry as being in the public interest. Under the 1999 Gramm-Leach-Bliley Financial Services Modernization Act, insurance activities, whether conducted by banks, broker-dealers, or insurance, and are regulated by the state. However, there have been and continue to be challenges to state regulation from some segments of the federal government as well as from some financial services firms. Accounting: insurers are required to use statutory accounting principles when filing annual financial reports with state regulators and the Internal Revenue Service (SAP), which evolved to enhance the industry's financial stability, is more conservative than the generally accepted accounting principle (GAAP) established by the Independent Financial Accounting Standards Board (FASB). The Securities and Exchange Commission requires publicly owned companies to report their financial results using GAAP rules. Insurers outside the United States use standards that differ from SAP and GAAP. As global markets develop, the need for more uniform accounting standards became clear. In 2001, the International Accounting Standards Board (IASB), an independent international accounting standards setting organization, began work on a set of standards called International Financial Reporting Standard that it hopes will be used around the world. Since 2001, over 100 countries have required or permitted the use of IFRS. In 2007, the SEC voted to stop requiring non-US companies that use IFRS to reissue their financial reports for US investors using GAAP. In 2008, the National Association of Insurance Commissioners began to explore ways to move from statutory accounting principle to IFRS. Also in 2008, the FASB and IASB undertook a joint project to develop a common and improved framework for financial reporting. Distribution. Property, casualty, and life insurance policies were once sold almost exclusively by agent, either by captive agent representing one insurance company or by independent agent representing several companies. Insurance companies selling through captive agents and by mail, telephone, or via the internet are called direct writers. However, the distinction between direct writers and independent agency companies have been blurring since the 1990s when insurers began to use multiple channels to reach potential customers. In addition, in the 1980s, banks began to explore the possibility of selling insurance through independent agents, usually bank agencies for that purpose. Other distribution channels include sales through professional organizations and through workplace. Auto insurance basics. Auto insurance protects against financial loss in the event of an accident. It is a contract between the policyholder and the insurance company. The policyholder agrees to pay the premium and the insurance company agrees to pay losses as defined in the policy. Auto insurance provides property liability and medical coverage. Property coverage pays for damage to or theft of the car. Liability coverage pays for the policyholder's legal responsibility to other for bodily injury or property damage. Medical coverage pays for the cost of treating injuries, rehabilitation, and sometimes lost wages and funeral expenses. Most states are required drivers to have auto liability insurance before they can legally drive a car. Liability insurance pays the other driver's medical, car repair, and other costs when the policyholder is at fault in an auto accident. All states have laws and set the minimum amounts of insurance or other financial security drivers have to pay for the harm caused by their negligence behind the wheel if an accident occurs. Most auto policies are for 6 months to a year. A basic auto insurance policy is comprised of 6 different kinds of coverage, each of which is priced separately. See below. Point number one, bodily injury liability. This coverage applies to injuries that the policyholder and family members listed on the policy cause to someone else. These individuals are also covered when driving other people's cars with permission, as motorists in serious accidents may be used for large amounts. Drivers can opt to buy more than the state required minimum to protect personal assets such as homes and savings. Point number two, medical payments or personal injury protection. This coverage pays for the treatment of injury to the driver and passengers of the policyholder's car. At its broadest, PIP can cover medical payments, lost wages, and the cost of replacing services normally performed by someone injured in an auto accident. It may also cover funeral costs. Point number three, property damage liability. This coverage pays for damage policyholders or someone driving the car and with their permission may cause to someone else's property. Usually this means damage to someone else's car, but it also includes damage to lamp posts, telephone poles, fences, buildings, or other structures hit in an accident.